So now that we learned the first section, which was of dealing with cash, right? Now we're going to be dealing with accounts receivable and what happens when bad debt comes around, okay? So when we understand, right, another form of way that we can collect money is by allowing our customers to charge on an account, okay? And we call this accounts receivable. So what this does is basically it's basically a liability for customers to have the obligation to have to owe you money and have them pay you back. So in this case, right, when we deal with sales, right, it's most important that when we are looking at a business that we have our products sold. Now, the dangers of having people owe you money is that you also have to understand that there's a risk of letting people owe you money. And that risk is you don't know what those people are, you don't know what their financial situations are, and you don't know if and when that they are going to make a payment for you, and are they guaranteed to make a payment to you, okay? So this is where we're going to be going to consider this to be a form of payment in regards to an IOU, right? Accounts receivable is basically IOUs, okay? On what we have to do here is we have to collect the information from the customer in order to be able to allow them to and to also keep track of who they are, how much they owe, and et cetera, what the products that they sell and buy. Okay. So again, when we are dealing with these kind of customers where they owe us on an account, there are many, many ways that you can, skim through the people who can have good trust in regards to making payments on time. So oftentimes you would run a credit score, okay, to see if they're eligible to be able to have the abilities to sign up for an account, and et cetera, et cetera. But that's not what this section is about. It's about having the ability to allow your customers to owe you on an account and what happens when they don't make a payment. So obviously, if they make a payment on time, great. We receive money, everything is good, and everything, we continue doing business with them, selling products to them, and they pay. Now, in this case, right, what happens when a given circumstance arrives and the customer cannot pay? Okay, so this is where we're going to introduce you to what's called the allowance for doubtful accounts. This is going to be considered a contra account. Okay, it's a contra account to accounts receivable. All right. Now, when we talk about the allowance for doubtful accounts, what this does is, right, when you're given the circumstances that a customer is flaking on their payments or, have some suspicious activities or something like that, right, where they're not making their payments or they're paying under what they owe. Usually, there's different ways that you can set up an account if you're gonna tell them to finance, which most cases a lot of accounts receivable do financing, or if you have the kind of set where we have terms where they must just pay the whole thing in 30 days. If not, you can't. You just keep charging them late fees. So there are many rules on how you want to do it. Now in this case, right, when we understand when a customer cannot afford to make a payment given to the circumstances, right, of one, they something happened, right, they filed for bankruptcy, two, just their financial situation doesn't allow them to make a payment, right, they have other priorities they have to pay for first that they just have to let this one go, or they simply just don't want to pay. And there are people who are out there that are like that, who just simply just don't want to pay. So when it comes to this conclusion, right, we know exactly who didn't make a payment, because we would know by sending them a statement, and if we don't receive a payment from them, then we know exactly who. Okay, how much, obviously how much they owe you should know, because you are the one that's keeping track of their account receivable. So you're the one that's sending them a statement, so you know exactly how much they owe you. And third thing is, you know exactly when they are not willing to pay you, because if one day out of the blue a customer decides to owe me money and the next month later they don't pay, then you know exactly when it happened. So those are the 3 key factors. You know exactly who, how much, and you know exactly when. Now, if you have these 3 key factors here, right, then that gives you that gives you the green light to say, hey, that means I have a potential bad debt. Okay? Now, what do you do with this potential bad debt? That's where the allowance for doubtful accounts come into play. Okay? Now, this is only considered potential bad debt. Okay? There is a possibility that the customer can one day wake up and say, hey, you know what? I can make a payment to you today. Okay? So let's go ahead and take a look at this example here. Okay? Where we have an allowance for doubtful accounts. So here, for example, on December 16, okay, Mr. Sanchez buys $100 of toys, okay, on an account, okay, and he pays $20 every single month, okay. So we charge no interest in this case, okay. So it's interest free for the first X amount of months, okay. And then, of course, it says every month he pays $20. So then that means starting from January, okay? And then in March 20th, okay, the following year, he files for bankruptcy and sends pretty much a notice saying that he can no longer pay. So in that case, right, we're going to record as usual, right? We're going to record that on December, right, that he bought stuff, we sold something to him, and he placed it on an accounts receivable, okay? So for $100, okay? Now, because we're not charging any interest or anything like that, right? Therefore, he makes his payment, and we give him X amount of months to pay it off, right? So January, he makes his payment, great, we collected $20. February, he makes a payment, great, we collect the $20. Now, March rolls around. And he tells us he filed for bankruptcy. He calls us. He says, I can't pay anymore. I can't pay anymore. Okay? So now, with that assumption, now we have to figure it out. Okay, Mr. Sanchez can't afford to pay for his remaining amount. So this is going to become potential bad debt. So when we think about it, right, it's not a loss yet because, even if you file for bankruptcy, you could still afford to pay some things off, right? Just when you're filing for bankruptcy, only a few things are let go. The major debts are let go, okay? So in this case, we still have potential to collect money from him, right? So in this case, right, because it's a potential bad debt, what we're going to do is we're going to credit our accounts receivable, right? He's already made 2 payments for his for the toys, right? So therefore, 2 payments, $20. So therefore, he's down to $60 left that he owes me. So in this case, right, this is what I'm gonna do. I'm gonna debit my allowance for doubtful accounts because this is going to be a contra account. It's decreasing my accounts receivable account. Okay. And I'm gonna debit that for $60. Okay. Now with this $60 here, that means I have a potential to either collect that money, continue collecting it from Mr. Sanchez, or I do have a possibility at the end of the giving accounting year, you can write this off as a bad debt, right? You can't expect to hold on a lump sum of money and expect 2 years later for someone to show up and finally pay, right? That's a little too long to wait on somebody like that. So usually, if it's within a year, 6 months, X amount of time there, you can make the assumption that you're never going to get this money back, okay? And that's where we talk about the next section after this, okay? But in this case, right, that's what we do, right? This is potential bad debt, and that's what we do during the current year. So when it happens, so in this case, we knew since March, boom, you journalize it as of March saying that you have potential bad debt, okay? So then let's talk about, well, what happens if you can never collect that money? this is where bad debt is actually going to come into play. Now, for most corporations or most companies, the IRS, this is a fun fact, allows you to write off up to 5% of bad debt as a loss, as no penalty is penalty free. You don't get anything else you don't get charged for that, or you don't because in most cases, right, a lot of businesses, a lot of corporations who have people who owe them so much money, 5% is a lot of money that they're expected to not receive that year. So every year the IRS allows you to take up to only 5% of bad debt. Okay. For smaller businesses, it depends on what it is, right? But that's just the general rule of thumb for IRS. Now, what does bad debt actually do? Well, in this case, this is where you are confirming that this money is completely uncollectible and you're never going to get this money back. So what you're going to do is you're going to consider this as a write-off for bad debt. Meaning your accounts receivable, right? You had customers charge money on that account. They never paid you back. You recorded it as an allowance for doubtful accounts. So now you've reached the conclusion where this money is never going to be collectible. Okay? Once you reach that conclusion, then that's where you're going to actually recognize this as a loss due to the bad debt expense account. Okay? And a bad debt expense account is going to be considered an adjustment entry that is done at the end of a given accounting period. So if it's 5%, could be every month, could be every year, at the end of the year, whatever it is, right? As long as it's some kind of estimate. Now, in this case, 5%. 5% of what? That's a good question, because in this case, right, when we understand what 5% is, 5% is going to be an estimated amount of number, okay? You don't know who. You don't know how much, except for 5% of what people owe you, okay, as a grand total of accounts receivable is going to determine exactly how much you're going to claim as a bad debt, okay? Now, of course, that estimated amount can include money that you tried to collect, right, your potential bad debt. So any money that you had already in your allowance for doubtful accounts, yes, you're safe to claim that and add it to the amount of debt that you are claiming that you're never going to collect. Okay, so this 5% is going to be an estimated amount. Okay, now here, do I know who? No. My assumption is if 100,000 people owe me money, I'm going to assume that 5% of that 100,000 people is not going to pay me back, right? Because that's the way of doing business, because I can't trust all 100,000 people to pay me back. In a perfect world, then yes, everybody should pay you back. But because of the given circumstances, we don't know. Maybe there's someone filed for bankruptcy. Maybe somebody lost their job. Any reasons that they cannot afford to pay you, the assumption is that you cannot trust all 100,000 people to pay you back. It's a responsibility that they have to pay. It's an obligation that they should pay, but are you going to get that money back? No matter how many letters, how many statements, how many late fees that you charge them, if that person doesn't budge, then your assumption is that, well, that's the cost of doing business, right? You can't assume that everybody will pay everything on time or just pay in general. So that's where your assumption is, that because if 100,000 people owe me money, right, I can assume that 5% of those people, not knowing who, right, I don't know who they are, because everybody can have a different circumstances, right? Everybody can have some kind of financial problem. And with that 5% of not knowing exactly who, right, I'm going to make an estimated amount. So it's an estimated amount of 5% of the accounts receivable. So 5% of those people with the 5% of the money that they owe me in grand total. So 5% of accounts receivable is usually going to be the number that you're allowed to write off as bad debt. Okay? And when does it happen? You never know if you don't know who is going to fault on their payment, you're not going to know when they're going to fault on their payment. So this can happen at any given time. Okay? So therefore, that's the key factors here. You don't know who, you don't know how much, and you don't know when it's going to happen. All right? Where the allowance for doubtful accounts, when you're doing it during the year, you know exactly who, you know exactly how much, and you know exactly when. Where when we're dealing with a bad debt at the end of a given accounting year, we're making a rough estimate. We don't know who, we don't know roughly how much, and we don't know when these people are going to fault on their payments. So that's the assumption here, is that we're taking an estimated amount and we're going to assume that this money is not going to be collectible. Okay? And then we're going to journalize it. Okay? Now, when we journalize that, we have two ways to journalize it, okay? We have the direct write-off method, and then we have the allowance method. Now, the direct write-off method is strictly for IRS purposes only, and it is only meant for the tax accountant to do, okay? Because what the direct write-off method actually does is it literally takes your accounts receivable and directly takes it out away from accounts receivable and just claims it as a loss. In this case, no. As a accountant or as a regular bookkeeper, right? You're just the general accountant. You cannot do the direct write-off because you're not a tax accountant and you are not going to follow the rules of IRS because, one, again, you're not the tax accountant. You cannot do this. You cannot claim you cannot claim bad debt right away from accounts receivable. So what do we need to do instead? Okay, so we're going to be learning the allowance method. Okay, the allowance method allows us to do a step-by-step process. So the first step is recognizing that there's potential debt, right? Using the allowance for doubtful accounts. Then we're going to exhaust our means to try to collect that money. Okay, whether it's 3 months from now, we send them a statement. 6 months from now, we send them another statement and charge them late fees. Or even if you have to go as far as harassing them, going to their door, knocking on their door, because you have all their information, mailing them, emailing them, calling them, whatever way that you're trying to do to try to collect your debt, then that is when you finally exhaust it. Then the last step you can do is transfer from the allowance for doubtful accounts account and then properly write it off as a loss. Okay, so in this case, there's two journals in between, right? There's the accounts receivable to the allowance for doubtful, and then there's the allowance for doubtful to the actual bad debt, where this one is written directly out from the accounts receivable. Okay, which is a big no-no. A direct write-off is meant for tax purposes only, and you're not a tax accountant. Okay. So in this case, right, we're going to be following the allowance method, which is governed by GAAP, and this is what GAAP tells you to do as a regular accountant. You are to properly take out every measures it takes to collect your debt, all right? And of course, with that being said, there are two methods that are underneath the allowance method, okay? And that is the balance sheet and the income statement method. So let's go ahead and take a look at our very first example here, okay? So we're going to be taking a look at the balance sheet method, right? Our scenario says that the example here is that it is estimated that $25,000 out of its $500,000 accounts receivable is to be uncollectible, okay? And there is currently a debit balance of $5,000 in the allowance for doubtful accounts, okay? So journalize this entry, okay? So this is how we're going to journalize it, right? Bad debt and allowance for doubtful accounts, okay? Because if we know this as a factor, right? If the allowance for doubtful accounts is a contra account, right? What should its normal balance be? it should normally have a credit balance, right? Okay? So in this case, because it's a contra account to accounts receivable, this had already happened prior. Now, if you haven't happened prior, that's okay. This is just a rough estimated amount. So here's the rules on how to use the balance sheet method, okay? The rules is that on the balance sheet, right, if I were to look at the balance sheet, it's going to list me out all of my assets, all of my liabilities, and all of my equity. And on there, it's going to show up your accounts receivable as well as your allowance for doubtful accounts. So that means on the balance sheet, my allowance for doubtful accounts appears. Okay? And if it appears, then this is the rule as follows. You're going to take a look at your estimated amount. All right? My estimated amount here is $25,000 out of $500,000. So in this case, my estimated amount is the $25,000. Okay? Now the key word that you're going to look for is accounts receivable, because if just by looking at what we just looked at earlier, right, the accounts receivable appears on the balance sheet. So therefore, I need to recognize this word here, that I'm taking an estimated amount from my accounts receivable. Okay? Then the third thing you're going to recognize is there a balance in my allowance for doubtful accounts? And if there is, what do I do? Okay? So in this case right here, it says that there is currently a debit balance of $5,000 in the allowance for doubtful accounts. Now, rule of thumb here is if it's a debit balance, my end goal is that I need to be at a credit balance, okay, in the allowance for doubtful accounts. So if I currently have a debit balance, then I have to backtrack, right? Looking at a number line, right? If you have +1, 0, and -1, right? How do you get to -1? You would, if you're at +1, you would have to go right twice, right? So in this case, right, my end goal that I need to be at is my estimated amount. So I need to be at $25,000 in the allowance for doubtful accounts. That's my end goal. But right now, I have a debit balance of $5,000. Now, if my end goal is to be $25,000 on the credit side in my allowance for doubtful accounts, how much do I need to get if I'm currently in my debit side right now for $5,000? So that's what you have to do, is you have to add those two numbers, right? If you're on the left side, 5,000, how do I get to 0? You have to go right 5,000, right? So that gets me to 0. But how many more do I need to go to the right to be 25,000? Another 25,000. Okay? So 5,000 plus 25,000 gives you 30,000. And that's how you solve for this one. Is that because there's a debit balance, your mind needs to say you need to add. And that's where you're going to be right here. You're going to add the two numbers together. Okay? Okay. Now, what if the same scenario happened, but this time you actually had a credit balance? So credit balance of 5,000. Okay? So if I'm on my number line, right? I'm right now at -5,000. How much do I need to get to equal 25,000? If I'm already on the right side, 5,000. So this is where it's going to tell you, if you have a credit balance, right, you're already on the right side. How many more right do you need to go to equal to 25,000? Simple answer. You subtract those two numbers, right? So you get 25,000 minus 5,000 to give you 20,000. Okay? And that's how you solve for the first one, which is the bad debt expense using the balance sheet method. Okay? Any questions so far?
Yeah.
Okay? So let's talk about the income statement method. Okay? This is where you'll get the same given scenario. However, you have to treat this a little different. Okay? So in this case, the scenario says it is estimated that $25,000 of its 500,000 total credit sales is to be uncollectible. There's currently a debit balance of $5,000 in the allowance for doubtful accounts. Okay, journalize it. So the journal's going to look identical. Everything about this is going to look identical. The only difference here is how do you determine which method to use? Well, when we talk about the income statement method, okay, this is what the income statement looks like, right? On there, you're going to have a list of all of your sales, whether it's cash sales, credit sales, or you'll have your cost of goods sold. So basically all your revenues and all your expenses listed out. Is there anywhere on here that says accounts receivable? No, right? Your assumption is your credit sales is going to be your accounts receivable. But in this case, the income statement, your accounts receivable does not appear. You only see total credit sales, okay? And because you see total credit sales, then that's what's that's the word that you're going to be looking for, okay? So in this case, right, like I mentioned before, if it's estimated at $25,000 of its $500,000 total credit sales, that should trigger you to use the income statement method. Now, the income statement method is going to be by far the easiest because all you have to do is look at the estimated amount of number. So in this case, my estimated number is $25,000. That's exactly what it's going to be. You do not care about the allowance for doubtful accounts. Why? It doesn't even appear on the income statement. If accounts receivable does not appear, your allowance for doubtful accounts would not appear either because, again, the allowance for doubtful accounts is a contra account. If the accounts receivable and the allowance for doubtful accounts does not even appear on the income statement, you ignore it. So the rule here is when you look at this scenario, right? You're only focusing on your estimated amount and the word total credit sales. So once you recognize total credit sales, boom, your journal is going to be for the $25,000. Okay? Even if you have another example right here where you have $25,000 of your $500,000 total credit sales, but this time you have a credit balance in your allowance for doubtful accounts for $5,000, right? If you go through the steps and the scenarios, right, and the things that I've told you, right, you only recognize the estimated amount. You don't even care about whatever balance is the allowance for doubtful accounts because it doesn't even show up on the income statement. So in this case, even if you had a debit or credit in the allowance for doubtful accounts, it doesn't even matter. You're still going to just take that $25,000 from the estimated amount because it is the income statement method. Okay? Any questions here? Okay? So, that's the chapter review. We talked about what happens when you place things on an account and if the customer decides to not pay or, does not pay you back, right? You're going to treat that as temporary, not temporary, potential bad debt, okay? So there you go. If you have potential bad debt, then you're going to recognize it as an allowance for doubtful accounts. And usually that happens during the year. You know who, you know exactly how much, and you know when it happened. Okay? Where bad debt happens when you reach the end of the accounting year and you realize that either somebody did not pay you or you can't collect the debt. Or, in this case, it's an estimated amount, right? You don't know who, you don't know how much, and you don't know when they're going to fall on the payment. So there you're going to make an assumption that at least 5% of those people or 5% of those accounts receivables will not be able to be collectible, okay? And that's where you're going to go into here where you have two choices. You can either use the direct write-off method or the allowance method. As I mentioned before, you're not the tax accountant, so you will not be using the direct write-off method. You'll be using the allowance method, right? And the allowance method, right, you have the choice. You cannot use both, either or, okay? The balance sheet method or the income statement method, okay? And then down here is how you journalize the bad debt. You're going to debit your bad debt expense and credit your allowance for doubtful accounts, whereas your allowance for doubtful accounts, you're going to debit your allowance and then credit your accounts receivable. Okay. So let's go ahead and dive right into the chapter 10.1 exercises. So this one's a little more easier, I hope, to understand. Okay. So let's go ahead and take a look at our exercise. Okay. So question number 1, all right. On December 15, Robert buys a total of 100 coffee mugs at $9.99 each, okay, on an account. Sales tax is 8.25%. So, how do I journalize this transaction? It is December 15.
Sales tax?
Sales and sales tax, good. Now, what is the account? What's my debit account going to be? If I sold to Robert and he bought 100 coffee mugs on an account, what do we call that?
Would it be accounts receivable or accounts payable?
Okay, so accounts payable is when we owe other people, right? Accounts receivable is when customers owe us money. So in this case, accounts receivable, correct. Okay. Now in this case, right, how much in grand total does Robert owe me? If he bought 100 coffee mugs at $9.99, how much does, okay, so in this case, what's my total sales going to be?
$999.
$999. No. I think so. $9.99 is going to be $999, okay? How much tax am I going to be collecting from Robert?
$82.42.
$82.42, okay? So then how much in grand total am I collecting from Robert?
$1081.42.
$1081.42, okay? And what I'm going to do here is I'm going to say sold 100 mugs to Robert. Okay? All right? So then, on January 15, Robert sends you a check for $25. So in this case, right, no interest. So he sends you a check for $25.
Checking account, debit, credit, account receivable.
Good, right? Because he's paying for what he owes. Right now, he's only giving you a partial payment. He's only paying you $25. Okay? And then you're going to go ahead and make a note here that you received payment from Robert. Okay. So then on February 15, right, Robert informs you that he can no longer pay you due to his financial situation. Okay. So in this case, he refused, he told you on February 15 he cannot make a payment. So this is going to be considered potential bad debt, right? So what are we going to do here? We can't just slide it off and assume that he's going to pay next month, right? We have to assume, right, we're going to place this amount that he owes me in another account because it's potential bad debt. So how are we going to journalize this? Right? We know who, Robert. We know when, February 15, and we know exactly how much he owes me, right? So what are we going to do here? We need to separate it, right? Because we know that this is potential bad debt. We need to separate it from our accounts receivable because everybody else, right, doesn't have a problem paying.
Bad debts to receivable.
No, that's the direct write-off method.
So it's not the allowance for doubtful accounts receivable?
It is the allowance for doubtful accounts. Okay, he said bad debt. Bad debt is wrong. This is the allowance for doubtful accounts. Okay? And you're going to take it directly out from the account receivable. Okay? Now in this case, how much does Robert owe me?
The difference between account receivable and 25.
What do you mean? What do you mean?
The 1,082 minus 81 minus 42 minus 25.
Correct. So how much does Robert owe me right now?
$10.56 and 42 cents.
$10.56 and 42 cents. Okay? That is what Robert owes me right now. And because he says that I can't pay you back, right? That means he might not be able to pay me back at all. So if I have this assumption, right, I need to make a separation because it's considered potential bad debt. This is something that he may or may not ever pay me back. So I need to place it in another account so I know that this person has a possibility of not paying me back. And that's going to be using the allowance for doubtful accounts. Okay? So there you go. We know exactly who, we know exactly when this happened, and we know exactly how much, right? We have it by using our, we would have an account ledger for this person. But in this case, there you go, right? If we know we charged them this much in December and they made a payment in January and February, this is how much they owe me. Okay? So then number 4 says, on a June 15, Robert says that he can pay $25, okay, for this month, all right? And he sends another check, okay, for $25. So in this case, right, he can make a payment after several months later, right? He decides to make a payment.
Checking
Okay, what else?
to doubtful account.
No.
Allowance.
you cannot directly take something out from the allowance for doubtful accounts.
And also, we don't have account receivable because
Because what?
we, yes, it is a credit from debit to credit, and now it is credit side.
Good. So we know that we took out money from the accounts receivable, right? We took out that he
Yes.
owes me money. But in this case, I cannot pay out from my allowance for doubtful accounts. So what should I do here?
Do you debit your accounts receivable?
Debit your accounts receivable. And what? Okay, I think you're treading on the right line, the right lines, Maribel. So yes, it is going to be the allowance for doubtful accounts.
So
Okay.
you're just kind of correcting the above one.
Correct. Yes. So in this case, right, this is what we're doing, okay? So if you think of it this way, you can understand it like this, where, there you go, I can't fit it. So when we understand it this way, right, here, Robert's account is active, right? And he pays just normally. And then one day he says, I can't pay. So we needed to deactivate his account. Now, all of a sudden, 3 months later, he says, hey, I can make a payment. What do you need to do? You need to reactivate his account. So by having to reactivate the account, you need to reverse the transaction because right now it's on hold, right? It's frozen. Think of it that way, right? The account's frozen. No activity can go in, no activity can come out. So now that we have to reactivate his account, right? We need to put the money back into the accounts receivable and we need to do it for the entire amount. Because now we're saying, oh, it's June 15. That means he's got money. He's going to make a payment June, July, August, September. He's going to continue to make payments. Okay? So our assumption is, okay, we need to reactivate his entire account. So therefore, we're going to do that by putting the 1056.42 back into the accounts receivable. Okay? To reactivate his account. And then we can go ahead and write that now we received the money and it's going to come directly out from the accounts receivable.
Yes.
Okay? For the $25. Even though he didn't make a payment for all of it, but that's okay because we have an agreement, right? We're giving him X amount of months to pay it off, no interest. Okay? So there you go. And then I'm going to go ahead and make a note here that we received payment from Robert. Okay?
Teacher,
Yes.
what about the here in the when you refer the account receivable? What is that?
What do you mean?
You don't write the. Yes.
Oh, like a description? I mean, yes, you can. I just figured this was the same one. So, in this case, you could say, to,
Yes. Reverse.
yeah, you could do to reverse, Robert's AR. Okay. Whatever meaningful way that you could describe this, this transaction. Yes. Okay.
Thank you, teacher.
Mhm.
I need to know just.
So then that happened there, and then now, it's question number 5 says, then on July 15, Robert files for bankruptcy, and the bank collector informs you that he can no longer pay, or that he can no, that, sorry, that this bill can no longer be collected. Okay. So in this case, it is now July 15. right? July 15. And now he says, now the bank tells you that, hey, this person has filed for bankruptcy, so they can no longer make any more payments, so you need to close this account.
Bad debts.
No, not yet, because it's only July. So in this case, I have to deactivate his account one more time, right? What was that, Maribel?
So we're just gonna redo again the same thing we did above before then?
Correct. Okay, so you're going to do the allowance again for doubtful accounts, and then accounts receivable. Okay, and this time, what's my amount for now?
1031.42.
1031.42. Okay. Okay, and then I'm going to go ahead and write to remove Robert's AR account. Okay. All right, question 6 says, now on December 31st, okay, your company estimates that $2,590.54 of its $29,475.72 accounts receivable are uncollectible, which includes Robert's debt, okay? And you have a total credit balance of $157.62 in the allowance for doubtful accounts, okay? So how do we record this? Okay, it is now December 31st.
Now are we into the bad debts?
Now we are into the bad debts, because now what's the key word that we're given to know that this is a bad debt? It's an estimated amount, right? You don't know who. You don't know how much. Well, in this case you do. And you don't know when, right? And in this case, right? This debt includes Robert's debt. So this amount that we have here for credit for $157.62, Robert's not the only one that owes you money. Robert might not even be the only one that flaked on his payments. So in this case, this is a general estimated amount on all of your accounts receivable. So in this case, that's the giveaway of how you know this is a bad debt. Okay? So, how should I journalize this?
Bad debts.
Bad debt expense, good.
And then is it allowance for doubtful accounts?
It is the allowance for doubtful accounts, because we can only use the allowance method. Okay, here we go. Allowance for doubtful. Oops. Full. Okay. So, what's the numbers that we're going to be using to determine the amount that we need to journalize? Okay. If it's estimated that $2,590.54 is to be uncollectible, okay, of accounts receivable, which includes Robert's debt. Now, the allowance for doubtful account currently has a credit balance of $157.62.
So are we doing the 2590 minus the 157?
Correct, right? Okay. So how much is going to be
2432.92.
2432.92 is correct. 2432.92. Okay. So in this case, right, we're using the balance sheet method, right, where we take our estimated amount, right, we recognize accounts receivables, that tells us it's a balance sheet method. So that means we care about whether the balance in the allowance for doubtful accounts, we care about it, right? Now in this case, there's a credit balance. Your end goal is to be a credit of $2,590.54, right? But you already have 157 and 62 cents in there already. So in this case, right, you're going to take the rule where if it's a credit balance, you subtract the 2. If it's a debit balance, you add the 2 numbers. So in this case, we subtracted the 2 numbers to get 2432.92. Okay? Good.
Can you say what do you mean by you would add the 2? Go back with that.
So again, if you had a debit balance, okay, if this was a debit balance, right? So that means you're on the left side, right? If you're on the left side, how do you get to the right side? If you were on the left,
Balance it. So then you would, okay.
you would, yeah, and then you would just add, yeah, basically, because the end goal is you want to be at this number on the credit side. Because if you were on the debit side, you would have to add it. But if you already are on the right side, how many more do you need to get to this side, to this number? You just subtract the 2. Okay.
Okay.
All right.
Teacher,
Yes.
the 29,000.
20. It's 2,900. Sorry.
70. What's this?
This right here.
An account receivable. This is the total.
That's your total accounts receivable. Yes.
And what this? What is the percentage of or the relation between the 2,590.54 and 29,475.74? What is the relation?
This is how much you're estimating that you're not going to collect out of this much money. So you earned a total of you own a total of $29,000, right? But you're saying you're not going to get $2,000 out of it.
So I got really confused on that one because on our example, when you were doing them before, it was like a clear 500,000. So that was like a much better number to look at than 29,475.
Right. It's because this is real life. You're not going to get even numbers in real life.
Right.
Yeah.
Is this percentage or what?
What do you mean by that?
How to estimate this 2,590 from 29,475? How to estimate this 2,590?
So remember, the IRS allows you to take 5% or up to 5%. So this could be less than 5%. I believe this is more than 5%. But in this case, it includes everybody that didn't pay you in the beginning, right? So this is just a number that you just make up. In this case, this was just a made up number. It has no relationship to each other whatsoever. It's a made up number. But in reality, IRS only allows you to take up to 5%. So it could be 3%, 2%, 1%, up to 5%. Okay, now obviously for major corporations like such as Walmart and Target, they're going to take the maximum amount. So they're going to estimate up to 5%.
Okay, thank you.
Mm-hmm. All right. Any other questions? So here I was nice enough to give you some more easier numbers to work with, okay? So the next following 4 problems are going to be not related to the previous section here. So number 7, if a company estimates that $20,000 of a $500,000 worth of accounts receivable is to be uncollectible. There is currently a debit balance of $5,000 in the allowance for doubtful accounts. How do you journalize this adjustment? So assuming this is what, December 31st, right? If it's estimated that 20,000 of a 500,000 accounts receivable. Okay? And there's bad debt
to allowances.
and allowances. Bad debt expense and allowances, okay? Now how much?
I think 20,000 plus 5 because it is debit.
Let's see, accounts receivable. Okay, so 20,000 accounts receivable plus a debit balance of 5,000 is correct. So the answer is 25,000. Good. Okay. How about this one? Okay, if a company estimates that 20,000 of a $500,000 of total credit sales is to be uncollectible, okay, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be
Bad debts and allowances.
okay, bad debts and allowance. Okay, and what's the number going to be here?
The different.
What do you mean?
Different between 20,000 and 500. 15,000.
No. Okay. Why is this one so different? Why is this one that I can't use the same rules that he just did right there? In this case, right, I have $20,000 and I have a credit balance of 5,000. So why can I not subtract the two?
Because you're on the credit side?
No. Okay, I try to bold the words for you so you guys can recognize it. So in this case, which go ahead.
So that's I'm kind of saying, like, so you have total credit sales on this one. The one above says accounts receivable.
What are the two different methods I taught you?
Oh.
So the first one was the balance sheet method, right? So what's this one?
The income statement.
The income statement. Now, does accounts receivable or allowance for doubtful accounts appear on the income statement?
Only credit sales appears on the income statement.
Only a credit sales appears on the income statement. So in this case, do we care about whatever balance is in my allowance for doubtful accounts?
No.
No. So what number am I going to be focusing on?
The 20,000.
Good. 20,000. Okay. So again, you have to be very careful on which method you are using. Okay. So again, we recognize it's the income statement method, right? The allowance for doubtful accounts does not ever appear on the income statement method. So the only number that we have to focus here is just that 20,000, the estimated amount. Okay. So then a company estimates that 20,000 of a 500,000 total credit sales is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. So the adjustment entry will be
Are we back to the previous one now?
What do you mean the previous one?
The the methods.
Okay, so in this case, yes. So what method is this one?
The balance sheet.
It says total credit sales. Does
The credit sales one is the income statement method,
correct.
right? But the
Okay.
next one.
We're on number 9
Okay. Okay. This is okay.
because this time there's a debit balance. Okay, where the previous one was a credit balance. Okay, so this one's a debit balance of $5,000 in the allowance for doubtful accounts.
But do we care?
Well, do you?
I'm gonna go back.
In this case, right, does allowance for doubtful accounts, does it appear on the income statement?
No.
Then you don't care.
Okay.
So in this case, what number do I actually care about in this case?
It's still the 20,000.
It's just the 20,000. Yes, okay. I know it's not. It's not that tricky, because the only difference here is one of them is accounts receivable, the other one is total credit sales. All right. So here, let's do another example. Okay, last example of the day. All right. If a company estimates that 20,000 of its 500,000 accounts receivable. Okay, so that should give you a dead giveaway that that's just the balance sheet method. That means the allowance for doubtful accounts does appear on the balance sheet. So therefore, there is currently a credit balance in the allowance for doubtful accounts. Okay? So if we know that the allowance for doubtful accounts appears on the balance sheet, do we care about it? Yes, we do. So if we do care about it, how do I go about the adjustment entry here?
Do we add the 5,000 this time?
What's the rule? Is it a debit or credit balance right now?
Credit.
It's a credit balance. So do you add or do you
15.
subtract?
Subtract 15.
You subtract, right? Because in this case, you're already on the right side. How many more do you need to get to 20,000? And you need 15,000 more to get to a total credit side of 25,000. Or 20,000, excuse me. Okay, so 15,000. All right. All right, so this one, if you're not really into logistics and figuring out what the true meaning is behind it, then I recommend you to memorize this. The 3 things you need to look for when you're dealing with the allowance method, right? To determine which method to use, right, you're going to determine, number 1, the estimated amount, okay? So that's already given, right? In this case, they're all 20,000, right? Now, the difference between the balance sheet and the income statement is basically the word that you're looking for. Do you have accounts receivable? That's going to tell you the balance sheet method. If it's total credit sales, that's going to tell you the income statement method. Now, of course, with the balance sheet method, right, we know that we care about the allowance for doubtful accounts. If it's a debit, you add. If it's a credit, you subtract. Whereas for the income statement method, you don't care. So whatever the estimated amount is, that's all you care about. Okay? Because we don't care about what the allowance for doubtful accounts is, because it doesn't even appear on the income statement. So we don't care for it. So therefore, the only number we care for is the $20,000. Okay? All right? Any other questions in regards to chapter 10.1?
Please, teacher, go back to the 8 and 9. Question number 8 and 9.
8 and 9. 8 and 9. So this one?
Yes.
Okay.
Okay, thank you. This total credit and this account receivable. In 10 account receivable, and question number 10,
So you want 9 and 10.
no.
Because
Now, now
8 and 9 are the same.
Go to the 10. 10. Go to the 10.
Okay.
The question, account receivable.
Okay.
This is bold. Account receivable. But at question number 8 and 9, you don't mention account receivable.
No, because that's telling you what method to use.
Yes, because there is no action subtract or add in the estimate and the balance.
Correct, because they're total credit sales.
Yes, total credit, no action.
No.
The same estimate. It is bad debts expense.
Yes, all the journals are going to look identical. The only difference is
Okay.
how are you going to calculate it. So when we did the inventory, right? All the journals are going to look identical. The only difference is how you calculate it. Okay? Yes, that's correct. Any other questions? Okay, well, if there are no extra questions, then so for homework tonight is to just finish